Hey, this is Sasha, and welcome to another episode on Hungry for Returns, where I answer your trading and investing questions based on my own personal knowledge, experience, and faults. So in either case, today's episode, what we're going to do is take a look at some investment portfolio managers. Now, if you have a specific question that you want to ask me, visit our website at tradersfly.com, and you can submit a question by writing one in the YouTube comments, or even sending one in by voice on the website. So let's take a quick look here at today's question. So here on today's question, we have David asking, hey Sasha, this just came to my mind, so I thought it's worth asking. So my uncle is the president at this lighting company, and he has a 401k along with other investment plans like IRAs. His stock isn't doing too swell in any of his accounts, and he blames it on the fact that he picked an aggressive account. But if the stock, which pays good dividend, is going down and it's an aggressive account, why couldn't the experienced portfolio manager maybe use options like selling calls for insurance? Wouldn't that make my uncle more money? I guess my main question is, why don't portfolio managers do a lot with derivative instruments to control risk just in case a customer's stocks fall? Thanks. Well, you got to remember how portfolio managers make money. There's different ways, but just to break things down for you, let's take a quick look. And basically it comes down to more work, and it also comes down to, is it worth it for them? Remember, most people are in it for their own best interest in mind. That's just the general scheme of human nature. And when they're managing a lot of money, it's just a little more difficult and time constrained. So let's take a look here. If we look at portfolio managers, here's just an average portfolio manager salary breakdown. But it's not important, the actual salary. What's more important is understanding where they get paid. Now, keep in mind, this might be different from one fund to the other, one manager to another, but this just gives you an idea, right? So let's say they get paid by salary. They'll get some bonuses in there depending on how well they perform. They might do some profit sharing as well. Maybe they'll get some commissions for selling some mutual funds to you, and then you get your kind of total pay. So that's kind of where the compensation comes from, sometimes referring clients. But in other words, you got your salary, you got your bonuses, you got your profit sharing, and you got your commissions, and that creates kind of their pay. Whether someone makes, 80 grand a year, someone makes 150 grand a year, some of them, if they get a bonus of 45,000 and they make 140,000, you could get $200,000-$300,000 a year for being a good portfolio manager. But remember, this is all relative, right? You might be getting someone kind of in the average of all of these. Whereas if you're trying to get the best portfolio manager, they might have higher fees. So if you're with, let's just say you're taking an aggressive fund, really the way that most people would do it, I mean, just imagine you're managing someone's money. Well, if I'm going to put my money into an aggressive fund, well, it could be more higher risk or higher volatility type stocks. So it could be something like a Tesla here, for example. So you might say, hey, okay, well, Tesla has a higher beta, more volatile. It could be things like an AMD. It could be things like an NVIDIA or an Apple. Well, that could be more aggressive. And then when you have something less aggressive, well, let's just say it would be more like Walmart. It could be more like a Home Depot. It could be more like a Disney. So now you're getting less aggressive. So whether it's aggressive or less aggressive is really just, it could be just the types of stocks that they're picking or the type of funds. You could just overall just look at the SPY and just get SPY, and now you're overall diversified. But here's the thing is that, remember, when you're looking at portfolio managers, could they use options to hedge these things? Yeah, absolutely. But it's more work for them. So for example, couldn't a car mechanic, if he saw a drip under your engine and he said, hey, I could fix that oil leak, or I could fix that coolant leak? Yeah, he could, but is it worth 5 hours of his time? And probably you're not really that interested in it. Maybe you're not interested in paying him an extra $500-$600 to manage that. So for them, because they have, let's just say, hundreds of clients, it could be thousands of clients depending on the fund, it may not be worth it for them to go ahead and adjust the risk problem that you have. Or if your fund is losing money, let's just say your investments are losing money, it may not be worth it for them to hedge that, because they don't really lose money if your investments go down. Instead, what they do is they lose their bonuses, right? They'll probably still get the salary, they'll still probably get the commissions, but it's probably not worth it for them to try and make that up in bonuses, because it might be just that much more work, because they got to do that with your account, with other people's accounts, depending on how they manage those funds and accounts. But in other words, it's just not worth the time for them. So they might not get the bonuses, but they still get their salary. They'll probably still get the commissions. So this is why really I always say nobody's going to care about your money as much as you do. Now, if you don't know how to trade, invest, maybe you're not good at it emotionally, those kinds of things, yeah, sometimes it's just, hey, it's much more worthwhile someone else managing your money, because then, well, you don't have to deal with that emotional side of things, and that may actually work out better for you. Now, maybe you don't make as much, but maybe you also don't lose as much during very volatile times. Like, for example, take a look here as we look at the S&P. Today it's down 66 points. Well, for some people, they would freak out and panic and could have a lot of losses. Whereas a money manager, maybe because he doesn't care about your money as much, he might just slowly nibble and add a little bit more to your account, you know, and buy a little bit more. And then with time, those things would continue to appreciate. So there's always trade-offs, of course. But to answer your question, could they actually use options to hedge those portfolios? Yeah, they could. But it is more work. And you know how humans are when it comes to more work. If there is no benefit or very minimal of a benefit, if it's marginal, it may not be worth their time. So if their bonus is, let's say, $5,000 or $10,000, if they hit certain amount, like let's say I was talking to a Lyft driver, right? If he hits 90, I think, rides every week, he gets $150 or $200 bonus or something along those lines. If he hits 130 rides a week, you know, you get another like $50 or $75, something like that. So what if you are only at 20 rides for the week and there's only one day to go? Is it worth it to push yourself to get many more rides and get that bonus? No, not really. So the same thing here. If you know you're already getting a $2,000 bonus, is it worth it to put that much more work and effort to get another $1,000 bonus if you're already making $80,000 a year? Probably not. So that's the case in point of these money managers and how things really kind of work, is that sometimes for them, it's not worth the time and effort, even though it may be better for you. Just like a car mechanic, it might be better for you to fix that oil leak, but you might not be the person willing to pay for it, an extra $1,000 to fix a little drip under your engine. So there's always those trade-offs, of course. So anyways, I hope that makes a little more sense. Remember, it's all about the payoff, the trade-off for every party at hand, and what's worth their time. So I hope this was helpful and insightful. And if you found this video helpful and you have a question, be sure to submit it on our website at tradersfly.com. You can even submit one by voice as well. Thanks for joining me. And in the end, remember, do what you love, contribute to other people, but most importantly, live life abundantly. I'll see you in the next lesson.